What if I told you there are 9 stocks trading at a massive discount with a potential 50% upside? Stay tuned because number 3 is going to shock you. It is a household name that's trading at nearly half its value. Welcome back to StockScope Live. My name is Ali and I'm your host. If you're new here, I work in the IT industry and I've been following the markets for over a decade. We're here to break down undervalued stocks and market opportunities to help you build wealth through smart investing. Today's video is special because we're in a unique market environment where there is a downturn in September and value stocks finally get their shine. With the Federal Reserve cutting rates soon in September, it's prime time for people to move money from overvalued growth stocks into undervalued stocks that have huge growth potential. And we want to capitalize on that in this time because September is historically a weak month. We covered that in the previous video, so please make sure you check that out. Before we dive in, this is not a quick money scheme. I'm not here to promise you millions of dollars. I'm here to deliver facts about strong fundamentals for these undervalued stocks that could help make you real money in the next 12 to 18 months. There is no certainties, only probabilities. Let's get into it. The first one on the list is Seagate Technology, ticker STX. This data giant is up 94% this year. And here's why it's not done yet. The explosion in AI computing requires massive data storage for the infrastructure. Seagate is perfectly positioned to benefit from this trend. They have improved profitability and strong cash generation. The company is trading at an attractive valuation despite being essential to the AI revolution. Now let's take a look at their chart. As you can see, they've been trading above their 20-day moving average since May of this year. And there's been massive investment from big money right around the July 30th mark, and they consolidated sideways and they're still trading above their 20-day moving average. At number 8, we have Western Digital, and that's ticker WDC. This is another storage play, 78% gains this year. This memory chip recovery is just beginning, and Western Digital is emerging as a key beneficiary of increased data center and demand for AI infrastructure buildouts. Similar to Seagate, their chart looks almost very much the same. Right around April, after the bit of a crash there due to political pressure, we've seen a massive rally. And as you can tell, they've been trading above their 20-day moving average since then. There was a little bit of a challenge here, but this rally has not stopped. And I don't think it's going to stop as long as they keep building more data centers. And if you look at their earnings reports, all looking great this last quarter and the quarter before, beating it by 20% in April, and then again by 16% in July. So looking forward to their next earning reports, and we're looking like we're seeing about a 14% upside in their earnings. So keep an eye on that. Moving over to the defensive sector that provides both growth and value potential. Coming in at number 7 is Bristol Myers Squibb, ticker BMY, and I've talked about this one before. This pharmaceutical giant is trading a 30% discount to its fair share value of about $66 per share. The company has a robust drug pipeline, successful acquisition of places like Karuna that has specializing in schizophrenia treatment, and strong partnerships. Despite patent cliff concerns, BMI is aggressively reporting and repositioning itself for long-term growth. Looking at their stock, you can see there has been a lot of sideways consolidation in this area. They're trading right around their 20-day moving average, and I'm guessing that this stock is going to make a comeback. They had positive earnings the last 3 quarters in a row. Keep an eye on it. Full disclosure, I do own some BMY, but I'm not telling you to buy it. This is not financial advice. Coming in at number 6 is an old one, Campbell Soup, ticker CPB. Now, this might surprise you, but Campbell Soup is trading at a massive 48% discount right now compared to its fair value. The company is leveraging AI and technology to optimize their production, with plans to unlock another $250 million in savings through fiscal year 2028. It's not your grandfather's company anymore. Looking at their chart, and in this year, or close to just the start of this year, we've seen some disappointing measures going down, consolidating, going down. But recently, we've seen a bit of an uptrend. They're finally trading above their 20-day moving average, and the 200-day moving average getting close. And this is where it's going to be a squeeze. Once these two lines start to get together, we're going to see a squeeze, and potentially there's going to be an upside. As you can tell, their earnings have been positive. But if we zoom out a little bit and we go back all the way in the 2022 to 2023, 2020 to 2023, this stock was trading in the 40s and the 50s. And so I think that this stock has the potential to make it back up to at least the 50 mark. And if it does that, we're looking at least a 50% upside from here. Keep an eye on this one. The next one on the list, coming in at number 5, is Chewy, ticker CHWY. The pet industry continues growth regardless of economic hardships. And Chewy has 20.5 million active customers, and it's expanding into vet services and prescription medications. The company's loyal base provides a steady revenue stream. If we look at their chart, in recent times, they've had an upside of about $50 for their next high. And in the previous times, right around February 2021, they've even reached $120. So we're not looking for that much upside, but if we're looking in the recent times, we're looking to at least challenge the previous high, which is about 20% from here. And then from there, we're looking at a much higher valuation of about $80 per share. Let's talk about some unique opportunities in emerging sectors. Coming in at number 4, MDA Space, ticker MDA.TO. This Canadian stock reported 54% revenue growth year to date and has an impressive 18-month backlog of about $16.5 billion. Now, defense contracts and defense spending are increasing, and critical infrastructure now includes satellite systems. This puts MDA in a very good position for massive growth in the future. Now, we can see that they've lost 25% in their stock due to some recent news about them losing their contract with EcoStar, which was worth about $1.3 billion and had a potential growth to $2.5 billion. But there's still a massive backlog outside of that. Now, EcoStar canceled the deal and separately announced they're selling their licensing to SpaceX for about $17 billion in cash and shares. And this includes their AWS-4 and H-Block spectrum rights, and this caught MDA by surprise. So that has nothing to do with the actual company's performance or any of their fundamentals. We're still looking at an upside to re-challenge those highs of about 47% from its current place at around $32.99. So I'm definitely going to be paying close attention to this. As you can see, their shares have been beat by 30% last time, 17% before that, 4% before that, and it goes on and on as they've made massive breaks. And if we zoom out, right around 2021, they were trading at a much higher place, and right around the pandemic, there was a massive drop in their shares. But we can also see a lot of buy-ins and a lot of big money moving in to the space sector. So definitely one that I'm actually going to be purchasing some stock in very soon. Coming in at number 3 is Global E-Online, ticker GLBE. This cross-border e-commerce online shopping platform is trading at 31% under its fair value. It just announced $200 million in buyback program for their shares, and it has very strong cash flows trending with the online shopping experience. Now, looking at their chart, we can see they've been doing a lot of sideways consolidating, and this has happened over the last several months, dating back to July. Going back to April, where everything kind of dropped between March and April, they saw a pullback into the upside. Now, they're still trading under their 200-day moving average, and it's getting close. Now, what we're looking for is possibly a squeeze somewhere in this area over here. This could be mid-October, and then we're going to see some sort of uptrend in that direction. We're looking at them reaching back to their target of $64-ish high from back in February of this year. And I think they can do it. Keep an eye on their stock, keep an eye on the news, and you'll be able to buy in at a good price. The next one on the list, coming in at number 2, is NRG Energy. We've talked about it before. This company is trading at massive undervalue, even though it's up 61% this year. Now, what's happening is the energy sector is exploding. There is massive opportunities, and they're investing heavily in renewable energy while maintaining strong cash flows from traditional opportunities within their portfolio. If you look at their chart, you can see that there's a lot of sideways consolidation that's happening in their stock. They had a massive breakout in May, which led to their new all-time highs, and then they broke that around $176. This stock, we're looking at a target value of about 230, and that's a 50% upside. They've never had a massive correction in their stock, as you can see, going back all the way to when they started. So I see this as a very strong play, and I have been urging people to keep a close eye on it and actually find a good buying position. It is trading right around its 20-day moving average, well above its 200-day moving average, and sooner or later, we're going to see a massive breakout coming in. So keep an eye on this one. Coming in at number 1 is Ramaco Resources, ticker METC. This metallurgical coal company is trading at a 48% discount. With infrastructure spending increasing and steel production recovering, Ramaco is positioned to benefit from increased demand for high-quality coal used in steel refinement. Trump talks about coal, Trump talks about steel, and this is why this stock is key in its industry. And as you can see on the chart, if we're looking at its MRSI down here, they're running at 8.69, meaning they're performing very, very well compared to their competitors in the same sector. Looking at their actual data, we see that since early July, they've had a massive breakout. They're trading above their 20-day moving average, well above their 200-day moving average, and they are looking to keep breaking these records. Right now, we see their lows are higher every time, their highs are higher. This is a very bullish indicator. I would see this stock going up at least 40% in the next 12 months. Make sure you set some reminders, some alerts, so you don't miss out on opportunities like this. And if you have any other tickers that you think are going to be number 1, make sure you drop them in the comments below, and we'll look at them and include them in our next video. If you've reached the end of the video, we're including a bonus stock, and that's Alibaba, that massive giant that is in e-commerce. They're currently trading around 145 USD with target price of around 220. Now, they've seen some headwinds from geopolitical issues and tensions, but they still have very, very strong fundamentals. Now, their earnings were missed last time slightly by 3.29%, but we still saw massive investments coming into the stock. And as you can see by these massive buys from possibly not retail investors, because we're not going to be moving the market like that big, at a volume of about $42 million on one day and around $82 million on another day. So why are people buying it? Why are big investors buying it when they miss their shares? Because they see the potential in this. Here's what most investors are missing. They generate massive free cash flow, $20 billion annually. And they returned about $4.1 billion to investors through buybacks. Their central bank in China recently did a 50 basis point cut. They've released new programs for property markets and direct funding for companies to buy stocks. This is the most aggressive from China announcements in years. And they've specifically targeted companies like Alibaba. Keep an eye on it. We're going to make a special video about it, and stay tuned so you don't miss a thing. And before you go buying any of these stocks, make sure you do your own research and consider your risk tolerance. All of this information is based on the most recent information in the market and strong fundamentals, but the markets are unpredictable. If you found this helpful, smash the like button, hit the notification bell so you don't miss any of these analyses in the coming weeks. And remember, there are no certainties, there are only probabilities. Remember, successful value investing requires patience and discipline. These stocks might not move immediately, but they have strong fundamental and growth potential that will hit their targets in 12 to 18 months. Thank you for watching. I hope you enjoyed this, and I'll catch you in the next one.